Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Today's podcast is a collaboration with Consensus, the market-leading blockchain technology company. Given its core position in the Ethereum ecosystem, we're able to bring you the most captivating industry insiders, from technologists and entrepreneurs to designers and creatives from all around the world. So join us for inspiring conversations on the future of finance, crypto, and what is making up the new decentralized web. And with that, let's get into it. John, welcome to the podcast. Very excited to have you here for the conversation. For our listeners, John is a co-founder and chairman of Monerium, which we'll dive into and talk about in detail. So again, thanks so much for coming on.
Well, thanks for having me, Lex. It's a privilege to be here. Thank you.
Absolutely. You have a fascinating career in really global financial services markets. Can you talk a little bit about just how you got your start and what have you been focused on historically that got you to today?
Well, it's a long time. My background is that I graduated in engineering, and at the time it was actually last century. Then I was among the first engineers to be hired into the banking system. It was then considered to be beneficial to be an engineer in banking. So that was a very interesting experience, and I was fortunate enough to get to know banking in and out. That's how the whole thing started. But then I also saw that there are interesting, shall we say, things happening within banks. And I was thinking about this in a larger context. What are we?
If I could, what kind of engineering were you doing in the banking world? And it's still very cool to be a developer in finance, as you know, but what are some of the early things that you were working on?
I specialized in operational research, optimizing how you run a factory or whatever. And when I actually went into banking, I said to the guy that hired me that, I really don't know anything about banking. You have to teach me everything. And he said, that's no problem. You have the math, and just he sent me on courses, and I had the privilege of diving into this whole thing.
Absolutely. So as you're going through a banking career, you're starting to notice things. So what's starting to come together?
Well, many things. I was thinking, what good is it that I'm doing? And I started to think about banking as maybe a call option is not the right word, but in a sense, in a bank is an institution where, the owners, they put some equity. And then the game is about leveraging that equity, taking risk. And, when you profit, but, when you have a problem, then you have a, huge safety net. So I felt interesting. And when you want to optimize something, then you say, okay, so how do you optimize this thing? Obviously, you have to take risks. And if things goes wrong, you will be saved. I mean, that was the strangest thing that I observed initially.
That's a pretty good bet for somebody taking the equity side of the trade. And so what around what time was this getting framed in your mind? What time period?
That was around maybe 1997 or 1998. Iceland had recently joined the European Economic Area. The banks were being privatized, and you were thinking, okay, so how is this going to play out? So I left banking in 1999 to start my first software company because I thought, this is a great job, but it's not creating any real value in my mind. So I decided to go into software. So started my own company and made some interesting software solutions.
What kind of software were you making?
Well, actually, it was something that was servicing the banking industry, something that I felt was missing and could make it more efficient.
I'm just curious, what was that? Because fintech is so big today, right? And in the first internet era, we didn't yet have the word fintech for it, but lots of good companies were made.
No, this was basically about plumbing in a way. That's the term we used. We just gathered the information, make it readily available easily for the bankers and the customers of the bank. We aggregated this and automated a lot of the processes that were there. These are basic stuff in those days. Then we built on that and just increased the service and the solutions.
Yeah. So, today data aggregation is a $5 billion company in the form of Plaid. So I think you were early and you're being modest. So tell us a little bit about the path from the software world and your entrepreneurial journey, and then the financial crisis in Iceland in 2008. How did you land in the role that you did? And we'll get to kind of what happened.
Yeah, so as a CEO of a software company, I was affected by the central bank because the central bank was affecting the price of the currency. And I wanted to export my product, but the central bank was always affecting the price, and that affected revenues and the cost. So I was thinking, why is the central bank doing what he's doing? And then I got really involved in that. I wrote a research paper with someone at the University of Reykjavik, and we basically thought that the whole monetary policy was flawed in the sense that it didn't account for the fact that this is a small open economy, and the models that they were following is designed for larger economies. So we became really concerned, and we wrote a lot of articles and reports to try to explain this. And so along with my career as a CEO of this company, I was also watching very closely what was happening within banking, within policy, within central banking. And at some stage, I was so worried that I called up the chief economist of the central bank and wanted to explain this to him. And he said to me that what I was saying was not mainstream economics. And since I was just an engineer, it was up to me to prove the whole thing. And that is when I decided to enroll into my PhD studies in economics. So that was in the year 2008 that I did that. And that's an interesting year because that is when the financial crisis hit. Also, of course, Bitcoin was introduced.
I want to get into that in detail, but before that, I want to just do some definitional work because you've alluded to a couple of things that I think are worth opening up. So, just the first point being that for people who are used to being in the US or in the UK and who don't think twice about having the reserve currency on their side, and also who don't export anything out to anywhere, or maybe between New York and Boston and London and a suburb, they don't experience this day to day. So you're saying that you had a software business that by definition, you needed international clients because that's who the large banks were. And the currency volatility that resulted from the monetary policy ended up literally causing pain to your business. How volatile were the revenues or the currency conversion that you were experiencing?
Well, it was not that volatile. The problem was that in mainstream economics, then the mainstream theory is that if you have an expansion within the economy, then you can slow things down by increasing interest rates. And when you increase interest rates, then the currency tends to appreciate. And when the currency appreciates, then import becomes cheaper and export less favorable. And the general thinking is that, well, that will mean that people will generally substitute imported products for local products, meaning that you will buy imported stuff and it's less favorable for the local industries to operate. And in that way, you want to slow down the activity within your economy. But what I noticed is that the expansion that we were experiencing before the crisis of 2008 was not because the activity of the economy, it was because all this activity within banking, and basically what was happening is that more and more people and banks, they were taking on loans or borrowing money from abroad. And when you borrow money from abroad, what happens is that, there's a flow of money into the economy. There's demand for local currency. The currency will appreciate. And yes, that means that those that are in debt in foreign currency, their debt will be lowered. Their equity, their own equity will increase. They have more leverage to get more loans and buy real estate or whatever. And that is what was driving the whole thing. And I was running this company and I wanted to export something. And I was always getting, fewer and fewer units of the local currency for my export, but the cost was getting higher and higher if you measure that in foreign currency. So my business was suffering because of this. And I was thinking, this doesn't make sense. Why does anyone think that this makes sense? And I also saw that, because the economy was so leveraged, it was in the end, at the peak, foreign borrowing by banks in Iceland was almost 8 times the GDP. And I would say, how can anyone think that this can go well? The central bank at the time, they had foreign reserves I think it was about 21% or something. And yes, they had access to swap and credit lines, but that was in the magnitude of 14%, 1/4. So you were really exposed to the risk that if foreign investors decided to pull their money out of the country, out of the economy, how would you fund your liabilities? The central bank can be a lender of last resort and can create its own currency, but they are not allowed to create, foreign currency. So I was really, really concerned. And I understood, why the chief economist at the central bank did this. But I also understood that this is not a model that works in this situation. Every situation is unique, and you have to understand, what is going on. So initially, I was just not happy with the way that the central bank was affecting the currency and how that affected my business. And I was just trying to figure out, why did they do it?
I'm always massively impressed by people who can run a multivariate open economy model in their head and walk through it, because for me, it's very quickly a labyrinth, right? And again, for lots of people, the rule of thumb is like supply, demand, closed economy, reserve currency. And here you're in a situation where your trading partners are potentially much bigger than you. And there's a direct line to the logic that is being explored now in the crypto economic space, where there are many pools of independent currencies. And, you have to have a logic as to how they interact and how they trade and the different pools of economic activity that are powered by those currencies. And essentially, that's almost the environment that you professionally grew up in, having to consider the open flows and the economic activity between many different partners of different scale. So here we are in 2008. You have what is maybe not the orthodox idea of what's happening. What happened next?
Well, there have been books written about the financial crisis of 2008 in Iceland. So I'm not going to give you a very long version of that. I guess I'm going to give you the short version of the short version. The short version is basically this. One, as we know, then banks are systemically important. And very often in many economies, you have just few important banks that the economy depends on. This is bank concentration. And then number two, what happened around the globe was that the banking system was at the edge of collapsing. And what happened in Iceland was, actually the entire banking system collapsed. And that meant that deposits and payment systems, they were at risk. The currency plummeted, it crashed, it lost half of its value. And this meant that, the real economy, the other part of the economy, just suffered. And people lost their life savings. They became bankrupt because, their mortgages were in FX loans. The currency lost half of its value. The loans went up, increased in value. The price of their houses, they went down. I think they lost about 36% at the peak. So people lost their savings in their houses. They lost even life savings. There was distrust. There were legal battles. The IMF came, bailed out the government. There was, humiliation, international dispute, referendum about bank bailouts. And the following decade was about cleaning up mess because banking system collapsed. This was extreme in Iceland, but this was something that was happening all around the globe. And we saw governments stepping in to rescue and restructuring the banks. In the UK, we saw Royal Bank of Scotland, RBS, we saw UBS, we saw AIG. But except in Iceland, by the time the government tried to rescue 3 banks comprising the banking system, basically, in 2008, it was too late. They were simply too big to save. And October 6th in 2008 is a day that I think most Icelanders remember. Most people know where they were, what they were doing, and how they felt, because that is basically when this became pretty clear. Through the national TV broke the broadcast and announced that the prime minister was going to address the nation life in the afternoon. And then the whole population understood that, something was seriously wrong. That's basically how it started.
Yeah. As far as founding stories go, it's a pretty good one. And I think a lot of people in our space, like for me, I was at Lehman Brothers. And so for me, that date is, September 15th. And I have a picture in my mind of Hank Paulson, George Bush, and Ben Bernanke and the rest of them announcing the outcome of the weekend where they decided they were going to burn down Lehman. So it was a special time. And again, I think in the blockchain space, a lot of folks have this foundational story. So I guess just to close that out, because you were engaged with the central bank and sort of like, what role did you play? And then if you could start getting us to Monerium and how the carnage of that time led you to think about a company like Monerium and what it does.
Yeah, well, during that time, I was living in New York City, and I was actually visiting that Monday, October 6th, and at the university. And I just watched, and I have been warning about this, that this could happen. So it was not a fun thing to watch. And basically what happens is that I became an activist, a rebel, if you will. I saw the government wanting to do the same as most government wanted to do. They wanted to basically reimburse the obligations that the private banks took on for depositors in the UK and in the Netherlands. And these amounts for Iceland were a magnitude that this would basically mean that you would have to tax people for decades to pay for this. And I said, this is not the deal we signed for. These are private banks, and if, yes, they are systemically important, but the deal is not that my kids are going to pay for this for the decades to come, Greek style. So what we did was that a few of us, we just, formed a grassroots organization and tried to prevent this from happening. We tried to provide advice to the government and say why it was better for everyone, including depositors in other countries, that you would not bail out the bank. You would not do that. And the government didn't agree with us. The IMF that was going to help us was pressuring that Iceland would take on this debt. The European Union was very of the same opinion. Of course, the UK government and the Dutch government wanted Iceland to pay for the bank's obligations. And we had 2 referendums in Iceland. And I was vocal in this. I was explaining why it would be a better solution not to do this. We had these 2 referendums where the people said, no, thank you. This is not what we want. We were taken to court. We won that case against the UK, the Dutch, and the European Union. We won that in 2013. And during that time, I had been asked to join a committee, try to solve the mess and work on solutions. And in 2013, I was elected by the parliament to become a member of the Supervisory Board of the Central Bank. And then later I served as the chairman. So I was, I was in the cleaning department and trying to make this better and make the financial system stronger. But of course, a lot of the work was just about how do you resolve these issues in a fair way and so on.
A lot of cleaning up for sure. I was trying to make a joke about hamburger making, but it's it's not coming to me. So I'm also fighting the urge to ask you about this like fictive modern monetary policy that has gripped people where actually you can print money without taxing your population base and it's just fine and money supply can go up forever. But I feel like that's maybe a black hole unless you've got a hot take on what's going on there.
All I want to say about this, this is a subject that I can talk about for a long time, but all I want to say is that fiat money is not going to go away anytime soon in my mind. And the government has a very powerful tool to make sure that there is always a demand for fiat money. And that is the ability to tax people. Because if you tax people, whether it's 30% or 40% or whatever, then you always create a demand for a local currency. You say, you have to pay the taxes, otherwise go to, I guess, jail or whatever. And then you have to pay the taxes in our currency. So you create demand. So even if it's created out of nothing, created demand. And also, in my mind, the most important thing about macroeconomics is that to control the fiat currency is basically very important to allocate resources, real resources, and for the benefit of the people. But then you have to know what you're doing. So I think there are many benefits that you have with the system. It's not perfect, but neither is crypto.
Yeah, it's funny. The connection just got made to your point of you need taxes to create the demand for paying in the fiat currency. Ethereum has a tax called gas, which requires people to pay it in order for there to be computation. And so that's my bridge into our meet around Monerium, which is the first European fintech to get an e-money license. It's completed the first cross-border euro transaction on the Ethereum network last year with TradeShift. Can you talk a little bit more about Monerium and the vision for both the company and the type of money that you see being powered by the company?
Sure. So basically what we saw in 2008 is, we saw the problem. The problem is, in our mind, that you have systemically two important institutions, that is the bank. And then we really thought about it. So if that is the problem, that you have too few, too big, systemically important institutions, how can you solve that problem? And the solution in our mind basically came to us. Actually, I met the current CEO of Monerium. He's also co-founder, Svein Alfeld, in 2012, and he introduced me to Bitcoin. And we were thinking, okay, so if you would have the local currency on this technical platform that is the blockchain, how would that have changed what happened during the financial crisis? And if you think about it, then why are banks so systemically important? Well, there are many things, but mainly because you as an individual or business, if you want to hold your digital money somewhere, you're forced to put it in a bank account. And what is a bank account? It is liability on the bank's balance sheet, right? So you're lending the money to the bank. That's the only way that you can be in control of your money, but still you're not in control. And that makes them systemically important. We are dependent on their solvency, that they operate and they don't go bankrupt. If they go bankrupt, we might lose our access to our own funds. So we thought the solution to this problem was, well, why don't you unbundle money and payments and banking? If the problem is systemically important institution, then isn't the solution to make them not systemically important? So if you can take the blockchain technology and use it and represent it, real money, fiat money, if you represent it as tokens where you are in control, you can transact, you can send it without any intermediation, you're not dependent on the banking system. Well, haven't you solved a lot of the problems?
Yeah,
I think so. So then we thought, okay, so if this is the solution, how do we do this? And when we talked about Ethereum and gas and the way that gas is kind of a tax, which I like this, talking about it this way. But when we saw Ethereum introduced in 2013, we realized that it could be the platform we were looking for. We could issue regular fiat money, real money, digital cash, and we could unbundle it from banks, bank deposits, and facilitate a new payment rate. So we thought, okay, so instead of the common approach to the problem that happened in 2008, the financial crisis, was to say, well, we just have to increase regulation, increase oversight, and so on. But that, in my mind, is problematic, because if you increase regulation and if you increase oversight, that means that the fixed cost of complying to regulation is going to go up. And that means that bigger banks are better positioned to deal with that, because this is about economies of scale, right? So instead of increasing regulation, we thought, why not just to try to unbundle money and payments from banks? It has so many benefits. And I came across a fantastic article recently by a professor at Cornell. His name is Daniella. And he talks about this in a very elegant and nice way, which I really like. But this is, what we were thinking. And Ethereum allowed us to do this, and smart contracts.
Yeah. So just to comment on the insight there, I feel like a lot of the simplistic framing in the crypto space is around Bitcoin as a money that doesn't participate in either, I don't think this is accurate, but as a story, that doesn't participate in inflation, and, you own it, therefore there's no fractional reserve banking. And for me, the idea that fractional reserve banking is bad sort of never stuck, because economies are greased by credit. And yes, there are cycles, and yes, they get carried away, and yes, the incentives can be wrong, but nobody wants to live in an M0 money supply economy. You need credit. It is a good multiplier of economic activity. But the insight that I'm hearing from you is it's all fine to have that, but just disaggregate what is the place where the money is from the credit creation capacity. And that's really powerful to me because it's consistent with both the framework of blockchain-based money is scarce and unique and fixed, and therefore you control it. And it's consistent with the narrative of you can have financial services that are derivative of that infrastructure, which is what we see in decentralized finance today. So as a follow-up question, there's been a lot of activity around putting different pegged currencies and cash equivalents on blockchain rails. So we have now, I think, somewhere around 35 to 40 billion of stable coins, which are sort of ish like money market funds, give or take. And then we've got various projects around the world that are trying to stand up enterprise private permission blockchains for central bank digital currencies with lots of caveats around path to production. And then we have projects like Monerium who've been added and are live. And so can you disambiguate a little bit the core concept and how you see the cash on-chain space evolving going forward?
No, I think this is really powerful what you're saying. And not a lot of people discuss the fractional reserve system. And, this was a deliberate act on behalf of policymakers like 100 years ago that we decided. There was a debate in the US, I think, 100 years ago with Irving Fisher and more economists. They were discussing, of course, narrow banking and fractional reserve systems. And the decision was that we would build our banking system on fractional reserve. You basically say that banks have a role in creating money through new credit, right? And that has facilitated a lot of positive things. So, like I said before, that is our fiat system. That's the way things are done. It's not perfect. I mean, this is a human construct and it can always be and has been developed over the years, and we should not stop doing that. So, and as I also said, then crypto is not perfect, but there are attributes there that we can use. And if we combine the construct of fiat money and as a way to manage the sensible allocation of resources and create new money, but we use the new technology to make the current system better by unbundling some banking functionality so it can serve us better. I think that is the big opportunity here. And so how do we do it? Well, when you move cash and you change cash into digital tokens, then that has consequences in the sense that if you as a business or individual, if you hold the e-money token, then you will ask, okay, so can I earn some interest on my funds? And then in this world, you would basically place them in what we call today some different funds that are basically funding something, whether it's a money market fund, which is funding the government or funding businesses or whatever. That is then direct lending. It's not creation of new money like banks do. And this is happening regardless of crypto. So if you think about what is happening in the US, there's a bigger proportion of lending done through funds than in Europe. And that means that the monetary policy has to take that into account because the channel for affecting the money creation is changed as more lending is direct instead of through banking where you create money through new bank lending. So I think that this is really important to understand that fiat money and banking based on fractional reserve and the token economy, they can coexist just as funds and lending through directly or indirectly through funds is happening today. It's coexisting with the banking system. But what I think is important is to unbundle this as much as possible and let the two systems simply compete. I think that is important. You also mentioned, CBDC or central bank digital currencies. Now, central banks are thinking, what can they do? They are in a tough position in a way because as a central bank, you're supposed to be the bank for the banks. You're servicing the banking industry. Right. And if you issue retail CBDC, that is to general public, what are you going to do? Are you going to offer them to store the money at the central bank facility? Are you going to be the innovator of technology and new business models? No, I don't think so. I don't think central banks should be doing that. I think the private sector has a much better role of innovating in terms of technology and business, but the central bank has a role there. And in my mind, it is about building the infrastructure for wholesale CBDC, servicing this new industry. And this is just in line what many have said. And there's also a very nice working paper issued by the IMF. The name of the paper is The Rise of Digital Money. And it basically says that, they're just proposing or they're suggesting that the way forward in this economy is that central banks basically offer their reserve accounts not only to banks, but to financial institutions, regulated, licensed institutions. And I think that's music in our ears, because I think that is just the way to do it. And that is the easiest way to unbundle money from banks and try to solve this core problem that we have with banking today, which is that you have too big institutions, too big to fail banks.
One of the things that popped for me is if you have wholesale CBDC accessible not just to depository institutions, but also to the other places that are building cash equivalents, which, as you say, there's a whole bunch of direct lending, and generally speaking, customers are getting much closer to the financial products these days across lots of different thematics. So yes, within lending more directly to projects through vehicles, but also something like Slack doing a direct listing rather than going through an investment in a bank intermediary, or Robinhood getting Reddit to invest directly in stocks. Almost in everything that we do, the internet brings people closer to the financial product. And so I wonder whether this problem of alternative financial markets, something like KKR doing essentially large balance sheet lending, if the opportunity for the shadow banking sector or the alternative lending sector to access some neutral technological account at the central bank with a wholesale CBDC and some friendly regulation around it, whether that actually solves this other systemic problem of the split of the higher risk activity from banking rails into the investment rails. But I've used up a lot of your time. And so maybe to close us out, the final question I have, given again the visibility that Monerium's got around blockchain-based B2B money movement and just the concept of blockchain-based money, the decentralized finance space has come into existence very quickly over the last year and a half and is using essentially the US dollar for its activity as the unit of account. How do you see the regulatory issues and challenges catching up with blockchain-based finance and decentralized finance? And then how do you see the intersection between, regulated money flows, fiat money flows as they become digital, and programmatic interacting again with the sort of crypto native ecosystem?
So first on the US dollar. The US dollar is of course the main currency used today, and we have seen what is termed as stable coins, which is an interesting term because there's no such thing as a stable coin. So I think we will move away from stable coins, because what is a stable coin? It's a proxy for money. It's a proxy for, and if you have the real thing, why would you settle for anything less? I think that we decided to apply to become a regulated institution to issue regular money, real money on blockchain. And we looked for what frameworks would suit us there. And in the US, you have different schemes or legal framework. And the problem there is that it's not designed the same way as the e-money legislation in Europe. So, the e-money legislation in Europe is basically designed to be a digital representation of cash. And that was supposed to be technologically neutral. So I think what we need to see going forward, we need to see more standardized rules for what constitute as money on blockchain. And I think the e-money framework, although not perfect, is a good example of how this can be done. Now, I think the way forward is basically you view regular money on different technical platforms, just as decades ago when we introduced the new technology of debit cards. That was a new technical platform to represent digital money. And in my mind, it's not so much different. So I think what we will see over the coming years is that regular money is going to be represented as e-money tokens or tokens. It's going to be just the US dollar is just going to be the US dollar, even if it's on a blockchain. And I think that will help to build this decentralized finance. And what we're seeing is that we see a lot of innovation, a lot of interesting ideas, how you can do it, how you can remove intermediaries. You have self-services of swapping assets, digital assets through smart contracts on blockchain. And this is just going to increase, you're going to remove the intermediaries, you're going to lower the cost, and you're going to increase automation. But fundamental to all of this is that we have real money on chain. And that is basically what we're focusing on. And at the same time, we think and we believe that this can dramatically improve financial stability because this is about unbundling money and payment from banking.
Absolutely. A fantastic overview. And you've had such an impactful career changing the economy and the world as a result. Where can our listeners learn more about Monerium and what you're doing?
So the Monerium website, monerium.com, is a good resource. You have all the contact information if you want more. We have a lot of articles, blogs, and so on about what we're doing and why we do what we do. So I think that's a good starting point for interested listeners, just to look at the professors and the IMF economists that are talking, how you can go forward, how can you basically do this. It is simpler than many think.
Absolutely. John, thank you so much for joining us today.
Well, thank you. My pleasure.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.